All right, so let's continue on here. Whoa. All right, so once you purchase a plant asset, you can have additional expenditures uh, dealing with this particular plant asset, and how it's treated depends on uh, what you're doing with it, what you have to classify this expenditure as. And so these expenditures are broken down into two categories. Uh, the first category would be considered a revenue expenditure, which means that it's an expense that is counted against the company's revenue in the period that the expense is incurred. It affects the income statement because it's expensed in that particular year. Whereas other types of expenditures are capitalized, and as such, you have to add them to the cost of the asset and expense it over its uh, future life. Now, if the amounts aren't material, most companies just expense the items. Again, the materiality uh, principle coming into play. And so the types of expenditures you can have are ordinary repairs. These are considered revenue expenditures and thus expensed in the year they're incurred. And the identifying characteristics of an ordinary repair is that it maintains the normal operating condition of an asset. It does not increase productivity, nor does it extend the life of the asset but beyond its original estimate. So uh, you have a vehicle you use in your business, and you must change the oil um, every so often, let's say 3,000 miles. Well, those oil changes are going to be considered an ordinary repair because you've got to change the oil to your business vehicle to keep it in normal operating condition. Well, compare that with betterments and extraordinary repairs. Those are considered capital expenditures and thus must be added to the cost of the asset and depreciated over its remaining useful life, whatever that might be. And so the identified characteristics for capital expenditure, these betterments and extraordinary repairs, is that they're major overhauls or partial replacements. They extend the life beyond their original estimate. So either one, it could create a situation where the uh, machinery is more efficient, therefore it produces more over its uh, life, or it, let's say it doesn't produce more, it just extends the life of the asset. Either one. All right, so let's talk about disposing of assets. First thing you have to do when you dispose of an asset is make sure that your depreciation expense is up to the date of disposal. And then after you have updated the depreciation expense, debit depreciation expense, um, and then you're going to credit accumulated depreciation, right? Then next you're going to journalize the disposal, basically by backing out the corresponding accounts dealing with this asset. And so the asset's cost you're going to back off the balance sheet by crediting it. You're going to debit accounts, excuse me, you're going to debit accumulated depreciation. Any cash received or cash paid would be either a debit or a credit. And then you're going to have probably either debits or credits that don't correspond. In other words, they're not equal. And so you're going to have a plug number that's going to represent your gain or loss. If it's a gain, you're going to credit gain. If it's a loss, you're going to debit loss. Now, if cash is greater than the book value of the asset at the time of the disposal, the book value again being the asset's cost minus its accumulated depreciation. If cash is more than that book value, then you're going to record a gain, being a credit. If cash is received as less than book value, then you're going to record a loss, a debit. And of course, if cash equals book value, you have neither a gain or a loss. So here we have an example, kind of a running example of our previous examples. Machine costing $9,000 and accumulated depreciation is also $9,000. So you're down to your salvage value, at least your estimated salvage value. And says on this is on December 31 of the previous year. It was discarded on June 5th of the current year. The company is depreciating the equipment using the straight line method over 8 years with zero salvage value. So bottom line is here you've got a situation, okay, so it costs $9,000. It's got accumulated depreciation of $9,000 with no, well, it is different than before because here there was no estimated salvage value. It was zero. So it's fully depreciated. You're simply going to back out the machinery for $9,000 and you're going to credit machinery and debit accumulated depreciation machinery. Tricky. All right, so here we have a situation where you're not fully depreciated. Equipment costing $8,000 with accumulated depreciation of $6,000 on December 31 of the previous year is discarded on July 1 of the current year. Company is depreciating the equipment using a straight line method over 8 years with zero salvage value. So they're depreciating they've got 2 more years basically of depreciation because they've already depreciated 6 of the 8, and so you need to bring your depreciation expense up to date by depreciating $500 depreciation expense up to July 1st of that seventh year. And so depreciation expense debit, accumulated depreciation debit, $500 each. And so you've got now your accumulated depreciation and your book values all set. Your book value being $1,500. And so that's going to be your loss because you're not receiving any income here. In other words, your book value is more than the cash received. Here, you're not receiving any cash, so you have a loss of the difference between book value and the cost of the equipment, $1,500. If upon the chance that you happen to sell plant assets at their book value, you're not going to have a uh, gain or a loss. So that's what this situation is meant to show. Here you've got equipment that originally cost $16,000. It has accumulated depreciation of $12,000 at December 31 of the prior year. Annual depreciation of the equipment is $4,000 using straight line. The equipment is sold for $3,000 cash. Okay. So here you've got one more year of $4,000 total depreciation, but yeah, we sell it after 3 months, so we're only able to update our depreciation expense for 1/4 of 4,000. So that's where they're coming up with depreciation expense of 1,000. And now that once you've done that, you've updated depreciation, you can record the sale of the asset. So debit cash, debit accumulated depreciation equipment for 13, and notice that cash equals book value, so no gain or loss in this situation. Here's a situation where you're selling above the book value. So here, same situation, selling equipment that originally cost 16 when accumulated depreciation is 12 at December 31 of the prior year. You're selling it March 31st of the current year. And of course, annual depreciation is still 4,000. The equipment's sold for 7,000. And so again, you're going to depreciate $1,000 depreciation expense, adding 1,000 to accumulated depreciation. So your book value is still going to be 3, but you're receiving cash of 7, so you're going to recognize a gain of 4,000 here. And last but not least, you have a situation where you sell the equipment for $2,500 cash. Same situation. After updating the accumulated depreciation, book value is still 3,000. So you're receiving less cash than the book value by $500, and so that's your loss on disposal. All right, let's talk briefly about natural resources. Um, this could be oil, this could be gas, this could be timber, uh, gold, coal, you name it. It's stuff you extract out of the ground. And so what we call um, this is not depreciation. It's the same idea of we're trying to match an expense with the revenue it relates to, but that matching is called depletion when you're referring to natural resources, not depreciation. So depletion is the term you're going to use. And so you're going to charge depletion expense over the periods that are that you benefit from this uh, gold mine, from this oil well, from this gas well, from this coal mine, whatever it is. And so the way you do that is very simply, it's your units of production method. You determine your depletion per unit, which is your cost minus salvage value. In this case, the cost is 500,000, salvage value there is none, and you divide that into the total units of capacity that you expect over the life of the asset. Here it's 250,000 tons. And so the depletion per unit is $2 per ton, and then you're going to take that depletion per unit and multiply it by the total number of units extracted and sold in a particular period. Here it's 85,000 units, and you multiply that times the $2 per unit depletion expense per unit, and so your depletion expense total is $170,000. And there's your journal entry, and down there at the bottom is what it would look like on the balance sheet. If you have any type of plant assets that are required to extract the natural resources, you record those assets separately on the books and depreciate them over their useful life. So you might have some extracting machines that help you to extract. Accounting for intangible assets. What are intangible assets? Well, they're non-current assets. They have no physical substance, but they certainly help the company in whatever it is they do. They often provide exclusive rights or privileges, usually acquired for operational use, and the useful life is often difficult to determine. Such examples of intangible assets are patents, copyrights, franchises and licenses, trademarks, trade names, goodwill, leaseholds, leasehold improvements, research and development, and other types of intangibles. And so you're going to record these costs, including the purchase price, legal fees, and filing fees, when you purchase patents, copyrights, franchises, etc. Now, understand that you add these intangibles to the balance sheet when you acquire them from someone else. So if you acquire a patent from the person who established the patent, you would list it at its cost plus any other cost to acquire. Same for copyrights, so on and so forth. If these are internally generated, you do not, um, you don't book these if they're internally generated, meaning you got the patent. Same goes for goodwill. If you're an accounting major, we'll talk more about goodwill and some of the later accounting courses that you'll deal with. But just know that their discussion of what's called amortization, which is equivalent to depreciation for tangible assets, deals with purchased intangible assets, not internally generated or created intangible assets. All right, that's it for Chapter 8.